Hello everyone, good morning. Today we are going to start with our part 2 next topic. Yesterday we have already completed one session and that was regarding the business taxation. I know in business taxation there are the whole chapter is remaining, but let's start with a fresh topic, and at the end, since we are going to take this lecture for more number of hours, so at the end we will be starting with the remaining topics. Okay, so let's start with the most important topic, that is partnership. In partnership you have to understand few things are very important. How the forming of partnership will be done, what is the basis of partnership, when there is a distribution from a partnership firm to a partners, how the basis will be calculated, when a partner contributes into the business, how the basis will be calculated. So main thing, the whole chapter is all around the basis of a partnership firm and basis of a partner in the partnership firm. So it is basically divided into two categories. One will be your this outside basis and one will be your inside basis. Okay, so just a minute guys, I think people are still joining. We'll just wait for 2 more minutes. So now let's start. Partnership, as I was explaining, partnership basis is important in this whole chapter. Okay, so first, what is the formation of the partnership? Forming a partnership is very easy. Like any unincorporated organization, like two or more people coming together, they can form a partnership, right? But certain organization cannot enter into a partnership. There is an exception list from this there can be one theoretical question, that if you're an insurance company, if you're a joint stock company, if you are incorporated as a C corp, right? 1120 C corp is a business where you are incorporated. You are a bank, you are organization who is wholly owned by the state or local government, organization required to be taxed as a corporation, foreign corporation, tax exempt organization, real estate investment trust, or an organization classified as a trust. So these are certain organizations, those have a totally different identity. They cannot enter into a partnership formation. Okay, so this is the exception. Now what are the types of partnership? Partnership can be general partnership or a limited partnership. Okay, general partnership is simple, all the partners are general partners. General partners means what? The liability is unlimited. Let's say partner A, B, C, there are three partners, they have contributed $100, right? And to run a business, they need to take a debt, they need to take a loan from a financial institution. So let's say they have taken a loan of $400 to run the business. Now this A partner is a general partner, but B and C partner are the limited partner. So this $400 will be liable to be paid by B and C only up to their basis. That is only up to $100 they can pay. Only up to the basis if they are liable, that is a limited partner. More than their basis. So remaining, let's say $100 is paid by B. Partner C is bearing $100, so remaining whatever is there, $200, this will be totally bared by A. Even though he contributed only $100, since he is a general partner, he will be liable for the amount which he initially contributed. That is called as general partner. Now in case of general partnership, all the partners will be general partners, but in case of a limited partnership, in case of a limited partnership, at least one will be general and at least one will be limited. Okay, and the rest of them can have the option either to go for a general partnership or a limited partnership. So this is the type of partnership, this is the formation of a partnership. Next is partnership agreement, can be either oral or written. If you want to modify your written agreement, you have an option. Before filing your tax return, you can modify your partnership agreement. Okay, next is exclusion from a partnership rule. Now let's say you are not earning profit, or you don't want to follow the partnership rule, then all the partners must agree till the due date plus extended due date. Okay, here you can modify the agreement till the due date, not till the extended due date. What is the due date for the partnership, guys? Anyone can mention in the chat box if you have already done these topics in the regular session. Since this is this is just a revision lecture. Okay, I'm not going to explain you everything in detail, just a quick revision. Yes, correct, it's 15th March. 15th March is the due date of a partnership. right? Because in regular class we have seen that because they need to issue a K1 to the 1040 filers, right? The K1 to the partners, they are going to issue a K1, and that K1 is need to be incorporated in the 1040 form, and the 1040 filing date is 15th of April. So at least 1 month before they are going to file the tax return. So due date for the partnership form is 15th of March plus 6 months. If you see the extension, it will come to 15th of September. Okay, so here partnership agreement can be modified anytime before the due date, not including the extension. But if you want to exclude from the partnership rule the partnership who is not actively conducting business, right? So for them, they can exclude themselves from the partnership rules. They can choose to complete or partial exclusion, and that has to be done by all the partners before the due date or extended due date. Okay, now what do you mean by family partnership? Based on this, there will be one question which will be straight away of 2 marks. Okay, if you are running a family partnership, means let's say me and my sister are starting a new business. Okay, now in that case, how the basis will be decided, how the capital contribution will be done, you have to check that whether the capital which you are contributing is a material factor in that business or it is not a material factor. So first thing over here on the left hand side, you can see where the capital is a material income producing factor. Okay, means we are investing, we are into the wholesale business, means we have invested our capital, bought the inventory from that capital, and that capital is generating the income for us. So that is why we will say as capital is material income producing factor. But let's say capital is not income producing factor. In that case, what will happen? We have not invested the capital for running the business, that is just admin related. Let's say we are running a accounting and taxation firm, right? So our skills are important, not the capital which is going to generate the income. Our skill are going to generate the income. So here the second meaning is capital is not an income producing factor. Okay, so in first case, let's understand that capital is a material income producing factor, or that requires the capital in a bona fide transaction plus actually owns and control the partnership. The interest capital is known as material factor if substantial part of business come from use of capital, right? Next is where the capital is not an income producing factor, agrees to contribute capital which is not a material. If in business income consists of only fees, commission, other compensation, right? Just take example of a accounting and taxation firm. So this can be recognized as a partner only if one condition is fulfilled. So let's say me and my sister are starting a business, right? And if it's a capital income producing factor is there in the business, okay, we are starting a business, but she has not produced any capital, she's just running a business with me, so she will not be recognized as a partner, since the condition to be fulfilled is what? She has to be contributor capital plus actually she should own and control the partnership along with me, right? So that is capital is material income producing. Let's say we both are EA, okay, and we started a firm, right? Now she is not a EA, she is just providing some other services to the firm, right? So that in that case, she is not a material, she is not providing her skills to the firm, she will not be called as a partner. It will be seen basically in family partnership. Okay, now distributive share of losses. Partnership income is there minus reasonable compensation for services that the donor renders. There will be one question based on this, where father is there, father is donating all his partnership share to his son. Okay, so whatever father might have contributed his services, so whatever is the partnership income minus his share of services, means he is going to receive any compensation or anything, so you are going to straight away reduce his compensation. Whatever is the remaining amount, that will be distributed amongst the donor's interest which is still in business. Let's say father was owning 100% of share in the partnership firm. Now he is donating 50% of his partnership interest to son, right? So whatever is the partnership income minus his share of compensation, officer's compensation we can say, or his share of compensation for rendering the services will be reduced. The reasonable share, whatever is remaining amount, that will be bifurcated among the donor's interest still in the business. Let's say father is still having 50% interest and 50% is owned by the son. So the question will be asked on this basis. They'll give you a calculation sum, they'll give you the what is the partnership income, what is the reasonable share of the father, and now they'll ask you how much is the basis of son into the partnership firm. Okay, so this is an easy calculation. Next is partnership in case of married couple. Now what happens if both spouse carries on the business together and share profit and loss? Then can there be a partnership agreement? There can be or there cannot be. Okay, there is no important thing like you have to have a partnership agreement, right? Not to treat the joint venture as a partnership. If they both are, this is qualified joint venture. This we have done on the first session previous day, that in case of husband and wife are running a business, right, they will be by default called as a partnership firm. But they don't want to go into the all legalities, they don't want to file a 1065 form, they want to just include that whole business in that schedule C on the 1040 return, right, as an individual filer. So that is the case where they are going to elect out of this rule. So not to treat the joint venture as a partnership if they meet all the following requirements. Only the members of the joint venture are the married couple, they both are filing a MFJ return, and both spouse materially participate in the business, and both spouse elect this treatment. Okay, both should mutually agree to treat it as a as other than the partnership form. Okay, if both elects, both will be called as a sole proprietor, and all income, deduction, credits, everything will be divided amongst them equally, or maybe whatever share they decide, based on that it will be added on their 1040 form schedule C. Okay, this is already done in our schedule C. You already know in our part 1. If you have not seen our part 1 revision lectures, please go through it. Okay, if you are appearing for only part 2 exam, please focus on the part 2 playlist which we have uploaded on the YouTube. Okay, if not elects means carry respective share through K1. You everyone know, right, those who have done the regular class, that wherever the income of a partnership firm is there, it will be distributed among the partners, and it is necessary to issue the K1 to each and every partners, so that those partners can pay the taxes in their individual tax return. In the partnership firm, the partnership firm is not going to pay the tax. That is why it is called as pass-through entity. If they do not elect, right, this election, treating it as a joint venture, if they do not elect it, then they will be carrying the K1 share as a joint in the joint return, and separate schedule SE will be created. Okay, next is limited partnership. We have already understood what is limited partnership. State limited partnership law, this is called as, it is limited at state level, it will be first created, right, composed under at least one general partner or more than one limited partner. Even if it's a limited partnership, you should have at least one general partner. If it's a general partnership, all the partners will be general. You know the difference between general and limited, right? It is all up to the liability. Whatever contribution they have made, if up to that much amount they are going to, bear the liabilities, that partner is called as limited partner. If the partner is having unlimited liabilities, means it doesn't matter what amount has the person contributed, more than that whatever person is liable, right, that type of partnership is a general partnership. Next is limited liability company, LLC. So when you're forming your business, first thing you are going to do is form a LLC. At a state level, you are going to register yourself as a LLC. Now what happens at federal level, LLC is not recognized, right? We all know that at state level it will be called as a differently, and at the federal level it will be called as a differently. So at state level it is a LLC, but to call it or to pay the taxes at the federal level, you have to either select yourself as a C Corp or as an S Corp or as a partnership, or you can go with a single member LLC, which is called as, also called as a disregarded entity. Okay, this will be treated directly on the 1040 form. But if you are a C Corp, if you are forming a LLC, you want to go for a C Corp filing, you will have to file a form 8832 to treat your organization as a C Corp. Okay, for in case of S Corp, it will be 2553 form which you need to file, and for the partnership, see, by default it will be treated as a partnership. No need to file a separate form. This we have already done in yesterday's session, right? Now let's start about the partnership return. This was all the basic things about the partnership. There won't be any question from this, but just two important topics. See, when I'm marking this thing in the class now, please make sure, if you have book along with you, please make sure to mark it somewhere that IMP means at least one question will be there from that topic, right? So here the calculation question will be there in case of donation of the interest in the partnership form. If a father and son are sharing the this share of a partnership, right, father is directly donating, it will be called as a gift by the father to the son of the partnership interest. right? So in that case, the question will be asked, what is the share of the son, or let's say what is the share of the father, like basis they will ask you. So the basis calculation will be done like this. Got it, guys? Next is let's move to, yeah, partnership return. 1065 partnership return. It's simple. You have to just add all your incomes, reduce all your expenses. Now whatever is your net earning, that has to be distributed, allocated between the partners. Now the K1, schedule K is our 100% share of profit. Whatever is income minus expenses you do, that is your net earnings. That will go to schedule K 100%. Now based on this, let's say there are three partners, A, B, C. All the three partners will receive a K1 in their own names. So let's say K1 for Mr. A, K1 for Mr. B, K1 for Mr. C. And on that K1 only 30%, like whatever is the share of their, sharing partnership interest or a share of profit and loss will be allocated in the individual K1s. Now K1 is distributed into different categories. Okay, when you look at practically the K1, it is based on all the incomes and losses items. Then the second segment is portfolio income, all your portfolio income. Then deductions, then you have certain credits, certain deductions, then you have self-employment earning, foreign tax transactions, AMT items, qualified business income. So this is the whole segregation of your K1 items. So wherever in question you see that if it's an ordinary income, net rental, other rental, guaranteed payment, all these things are going to be shown on a separately stated items, that is schedule K1. If it's a portfolio, right, all the passive related income, interest, dividend, royalty, short-term, long-term capital gain, collectible gain or losses, unrecapture section 1250 gain. Okay, this we will see in the basis of property. Basis of property, I think there is already one whole video uploaded. Today if you have time, you can just go through that depreciation video, right? It will be covered in that. And then next section 1231 gain. When you sell a property, you have to recapture your depreciation part, right? So these two things are related to the sales of a property. So if a partnership firm is selling certain property, right, then you have to recapture the depreciation part and call it as a ordinary income. Okay, so that is what will be shown directly on the K1 instead of your 1120S or 1065 page 1. Then we have a distributions. Let's say the partner is taking certain distribution, or let's say there is a section 179 deduction. There is a difference between section 179 and a bonus deduction. When we do the basis of property, I will explain you over there again. But now whatever is this 179 deduction, why it is shown on the schedule K separately? Because each individual person will have a own limit on their 1040 return. Okay, so that we have already understood in the regular class. I'm not going to repeat that thing again. This is just a revision batch. Okay, so what will all be included in the schedule K1? All the income losses items, all the portfolio related deductions, and self-employment earning, credits, foreign transactions, if the partnership have entered into any foreign transaction. Because see, why they are, this all things are included on separately stated, because each and every item has an individual limit on the 1040 return. Okay, and anyways partnership firm is not going to pay any taxes. They will have to allocate all their income to the partners in the form of schedule K1s. The small K1s will be issued, right? Now next thing is K2 and K3 were the forms which were issued, which were generated if the partnership firm is entering into any international tax transactions. Okay, so simple way, schedule K will show 100% share, and particular share will be shown of each partner on schedule K1. Okay, this everyone know. Same way, this is an extension of schedule K2 is an extension of schedule K, means whole 100% share of your foreign transactions will be shown, and the particular percentage of each partners will be shown on schedule K3. Okay, got it? So K2, K3 is simply this thing. There is no detailed question or detailed explanation which will be asked in the exam based on the K2, K3. You just have to remember the base thing concept. You just have to remember that any transactions which are used to report, any transactions which you entered, which a partnership is entering to report the international tax relevance related transactions. Okay, any foreign related transactions will whole be shown on the K2, and the particular share of each partner will be shown on the K3 form. Okay, and that will be included in the return. Now partnership firm is having a loss, for example, right? If they are having a profit, there's no need to do any calculation. Directly the profit will get distributed amongst each partners. Now if a partnership firm is having a loss of 1 lakh, and let's say two partners are there, both will be allocated 50,000 loss, and here 50,000 loss will be there. Now when they prepare the 1040 return, can they take the whole loss in their tax return as a deduction? The answer depends on the rules. All the stepwise rules you will have to apply. First is basis rule, second is at risk rule, third is passive activity, and fourth is excess business loss limitation rule. Now these four things I'll just explain it in a very short manner, because in upcoming slides you will see that we will have this topic later on again. Basis rule is simply what, let's say Mr. A and Mr. B is there. Mr. A is investing $1 lakh, right? $100,000 he has invested into the business, contributed into the partnership firm. Now during the whole year they have earned a profit. Let's say it's year 1. In the year of contribution they have earned a profit of just 10,000. In the same year he took a distribution, he took some distributions of $10,000. So can I say what is his adjusted basis at the end of the year? It is still 1 lakh. Now let's say in year 2 they made a loss of 50,000. So can I say now what is the basis in the year 2, and it is 50,000, right? Now in the next year again they had a loss of 10,000. So now what is the basis is 40,000. Now in year 3 they have incurred a loss of whole 1 lakh, out of which partner A's share is 50,000. So this is more than the basis, right? What is the basis? What is the adjusted basis? It is just like a partner's capital account, which we call in India, right? Include all the incomes, reduce all the losses, reduce all the distributions, include all the contributions. All this thing will be added and reduced. Now main thing in partnership chapter, you have to identify when a partner contributes certain thing, maybe property, maybe cash, or anything which a partner is contributing in a partnership firm, what will be the tax treatment for that? Whether it will be exempt, whether he is going to include it as a taxable, or whether the partnership firm is going to record anything, like what will be the basis. See, I am contributing, let's say I don't have cash, but I have property. I have invested property into my business, right? So that property's price will be called as my basis in my partnership firm, right? So that we'll understand later on. Now let's see if a loss is more than my basis. What is my basis right now? Adjusted basis is just 40,000, but loss is 50,000, right? So up to 40,000 you can first allocate. So my total loss, you have to calculate this in this manner. First allocate it to the basis. What is my basis? It is 40,000. So what is the remaining 10,000? Okay, now let's see how much I am at risk. Let's say I have contributed the property. Along with that, on that property there is a mortgage which I am paying right now. So can I say I am at risk? Or let's say I am not paying any mortgage, but I have borrowed some money and put it into the business. So the liability which I am bearing, that is called as I am at risk for that much amount. Okay, so the liability, let's say I borrowed 5,000 to invest into my business. So that is my at risk. So remaining, out of the remaining 10,000, I will allocate the next to my liability. Okay, that is the at risk. So remaining 5,000, I will see that can I use it against the ordinary income? Can I allocate it against the ordinary income? Because what will happen, guys, understand this, that schedule K, whatever is received by the partner, right, it will be considered as a passive related income. It will be passive income unless and until in schedule it is mentioned that the partner has actively participated in the business. Okay, if it is there, then it will be ordinary income, but anyways the schedule K is known as a passive income for the partner. So what happens now? Along with this, let's say there is some other passive related losses already in there in his individual 1040 form. So we have done that in the 1040 in the part 1, that if you have a passive related losses, it can be offset against only passive income. Passive means what? Any unearned interest, dividend, royalty. So this all which we saw over here, right? Interest, dividend, royalty, short-term capital gain, all these are passive related, means you are not personally involved in earning those income. So any passive related losses are there will be offset against passive income only, right? But if you have a rental related losses, and if your AGI is up to certain limit, right, up to $1 lakh, then you can offset 25,000 against the ordinary income. So first you will offset that and then see that whether you have any remaining ordinary income or not. If yes, then you can offset this passive related amount against that ordinary income. Okay, the schedule K is your passive, and that's why the setting off limit is up to 25,000. Only up to 25,000 you can take as a offset against the ordinary income, not more than that. Got it, guys? This we have done already very well in part 1 revision. If you want, you can just revisit that much part, but this is the same thing which I explained. Schedule K is your passive activity, right? And when it is being carried to our 1040 form, you need to check that first you need to allocate the existing passive loss which is there in his form. Okay, in his 1040 return. Let's say rental activity loss is there. He'll first allocate that, but the limit is up to 25,000. And that 25,000 will cover that rental passive loss, the schedule K loss also, and then you have to see that if anything is remaining, excess business loss limitation will apply, means it will get carry forward to indefinite period of time. So that is how we are going to allocate the partner's losses. Now when to file, as we have seen, the partnership filing date is 15th March and the extension is again 6 months. The extension time period is same as there in case of the 1040 returns. Okay. Required tax year. So required tax year of a particular partnership firm, it can be a fiscal year or a financial year, but that will depend on what financial year, what tax year the partners are following, right? If more than one partner is having the same year, same tax year, plus majority share partners are having the same year. Let's say A, B and C, all the three are having Jan to December, Jan to December, Jan to December. Then the partnership will be following Jan to December. But let's say Jan to December is followed by A, B is following March, April to March, okay, and C is again following Jan to December. Now you have to check that this two person, any of them are having the highest share, majority of share they are holding or not. If yes, then we will be using Jan to December as a tax year. Okay, so there can be one theoretical question based on this. They will give you that what year they are using, the partners are using, and based on that what will be the partnership's tax year. Okay, no majority of share. Let's say they all are having equal share. There is no majority. In this case, let's say this is 50% shareholding and this 2% are holding 25%. So who is the majority shareholder? Mr. A. So Mr. A's tax year will be used, that is Jan to Feb. Okay, but let's say all the three are holding equal shares, that is 30%, 30%, 30%. Then use the tax year of a principal partner. What do you mean by principal partner? More than 5% shareholding is the principal partner. Okay, now let's say there is no majority, there is no principal. See, in this case 30% means, can I say all are having more than 5%? There is no majority. Then you'll have to do a small calculation of a deferral period. And I know many of you might get confused in this calculation. That's why I'll just directly take the example so that you can understand it very well. Okay, see, the percentage of share you have to check. What percentage? See here 30, 30 and 40. What is the majority for 100? It is 50%. No one is holding more than 50% and all are holding more than 5%. So can I say this is the third situation? No majority and no principal partner is there. Means more than 5% everyone is holding. And let's see what are the tax year they are having. The tax year for Sam is ending on 30th June. For all, it is ending on 30th June. For Tim, it is ending on 30th of September. So you have to do a permutation combination, means take Sam and Earl's tax year difference, take Sam and Tim's tax year difference, and do a vice versa also. So there will be permutation combination like this. You have to just take the share, right, multiply by the difference between the tax year ending date. That is a deferral period, we will call it as. Okay, so Sam is having how much? Sam and I can say Tim will not compare it with all because it is 0, right? June minus June is 0. And reverse also case, it will be 0. You have to check the ending period of Sam with the Tim and all with the Tim. Okay, Tim is having ending on September. Sam is having ending on June. So what is the difference between June to September? It will be 3 months, right? July, August, September. 3 month multiply by what is the percentage of Sam. Right now, first we are calculating for Sam. So take the percentage of interest for Sam. So it will be 0.9. Okay, same way, difference between the Earl's ending tax year and the Tim's ending tax year comes to again 3 months into 30%. Now do Tim's tax year, right, minus Sam or all. Even if we take Sam or all, it will be same only. So from September to June, you have to check. See, always remember, whoever you are taking first, take his tax year over here minus September. So it comes to 3 months. But when we talk about Tim to all or Tim to Sam, it will be September till June. So you'll have to calculate after September how it will be done. October, November, December, Jan, Feb, March, April, May, June. 9 months it will be considered, right? So 9 months. Make this correction in the book, guys. It should be calculated from Tim's ending year to Sam or all's ending year, right? So 9 months into what is the share of Tim? 40%. Whichever is the lowest, right? When you do this calculation, whichever is the lowest, you have to check. It comes to Sam and all. So hence we are going to use the tax year which is equal to ending on June 30. Okay, there can be this type of calculation, but in it will be in the very rare case. In the very rare paper, this calculation will come. But please make sure to remember this. If more than one partner is having the same tax year, plus majority share partners are having the same tax year, okay, then use that tax year. Do the majority. But let's say there is no majority, everyone is having 30% and there is no majority of share which is owned by a maximum number of person, then check who is the principal owner owning more than 5%. If all are owning more than 5%, no majority is there, then do this deferral calculation, which is very simple. Just take a difference between the tax year of one partner minus difference of minus the ending tax year of another partner. Take a difference of the month, multiply by the percentage of interest. Do all the same things, repeat this for all the 3 partners or 4 partners, how many number of partners are there for. Do that thing for each of them and take whichever is lower will come, right? So it comes 0.9. 0.9 is the share of Sam and all. So for Sam and all, what was the tax year ending is 30th June. We will use that as a tax year. Got it, guys? Filing penalty, mostly filing penalties will not be asked in exam. This is specifically asked in the part 3 paper, but still you have to remember, if you are filing a late return, what is the due date? Again, I'll repeat, 15th March. If you're filing a late return or you are filing an incomplete return, right? Or if you have failed to file by due date or extended due date or return with incomplete information, you will be filed with a penalty of 210 for each month or part of the month, maximum for the 12 months. After 12 months, again, you are repeating the same mistake. It will be multiplied by number of partners in a partnership firm. Okay, so it will be a very huge penalty. Same way, if you fail to furnish K1, K2, K3 to a partner, because if you are not furnishing these 3 forms, the partner will not be including it in the tax return, right, in the 1040 return. So if this mistake is happening, what will happen for each failure? Let's say there are 10 partners. If you don't issue 10 K1s, what will happen is 10 into 280 times you will have to pay the penalty. So 280 for each failure you will have to pay. If you fail for this also, it will be 570 or 10% of the amount to be required to be reported. Let's say your ordinary income is $1 lakh, right? And you don't issue any K1, you don't pay the $280 also. Then second thing is, if you willfully do it, like even though the partner are asking, even though you know that you have to issue the K1s, still if you're not paying it, what will happen? 10% of whatever amount is required to be reported, you need to, pay that much penalty, or 570, whichever is higher. Okay. Partnership centralized audit. What do you mean by partnership centralized audit? In that case, IRS is going to assess your tax return, right? So if you want that, you don't want to enter into a centralized audit, you don't want to make your partnership in a centralized audit thing, then there is a schedule B2 which will be used, where you need to collectively mention, all the partners should mutually agree and sign that we are opting out of the partnership audit. But you cannot opt out if you have to issue a K1 to some other partnership. See, all the individual partners are there in the partnership firm, then that's fine. But if the partner is in the partnership firm, the partner itself is a partnership firm, another partnership firm, or a trust, or a foreign entity, or an estate, or a representative of a partner, right? Then they cannot opt out of a centralized audit. This is what it is. There will not be any question, but still it's a theoretical point. You can just Partnership can request to modify the imputed underpayment and may elect to push out the adjustment underlying the imputed underpayment instead of paying. So let's say IRS has audited their particular return and everything, and they tells that this is the amount of penalty or this is an underpayment of tax which you have made. Now what the partnership firm can do is they can, instead of paying this unpaid taxes, they can push an imputed underpayment instead of paying. Okay, so this thing is something which is called as, which is there in the partnership centralized audit. We have done this in very detail in the class, so I hope you guys remember that in case of partnership audit, if you want to opt out, designated partnership representative is going to handle this each taxable year. So every year you have to assign a designated partnership representative. Okay, if the partnership firm are having less than 100 partners, they can easily opt out for the centralized audit. Okay, got it guys? So this is one thing. Next thing is, okay, so our main thing is getting started, that is transaction between the partnership and a partnership firm. So what are the transactions that a partner is going to enter with a partnership firm? That is very simple. First main thing is, if you are entering into partnership, let's say you have made a contribution. See, now I will be going a little bit slow because this is the main crux of this whole topic, that is contributions, distributions. What way you are contributing? Let's say you are contributing in the form of property or in the form of cash. So what will be the basis for the partner? What is the basis for a partnership firm of that particular property? Okay, so here second thing is, let's say the partner is receiving a payment from a partnership firm. Okay, he is providing his services. He might be receiving certain salary, wages, or guaranteed payment. So you have to understand the difference between guaranteed payment and minimum payment. Okay, so let's see, in case of the following situation, treat the partner not as a member of a partnership firm. Okay, let's say partner is just performing services or transferring to the property to the partnership. If related allocation and distribution to the partner means, this means what? Let's say I am just providing my services to the partnership firm. Against that, partnership is providing me some property, or against that, partnership firm is paying me certain amount. Just because I am providing certain service to the partnership firm and receiving the amount in form of salary, wages, this doesn't mean I'm a partner of that partnership firm. So you will not treat a partner as a member of a partnership firm. I am just providing services, and against that I am receiving my income. Okay, or let's say I am transferring the property to a partnership firm. So entire transaction, when viewed together, is properly categorized as occurring between the partnership and partner, are not acting in a capacity of partner. I'm just providing my property, against that they are paying me the rent on continuous basis, right? So the entire transaction is not in with the intention to contribute the property in the partnership firm and to become a partner in the partnership firm. So this is the two cases where you will not treat a particular person as a partner in a partnership firm. Okay, if a partner is transferring money or other property to partnership firm, this is related to transfer of money or property by a partnership firm to contributing partner or another partner. Okay, so just a minute, wait, we are going to do it in a whole chart format which is already there in our book. Just a minute, I'll just first explain from that. At the end of the corporation chapter, there is this chart. Just after this, there is a corporation, and yeah, here it is. So see, let's start with the main topic. Like, if first we are reading with the right hand side, the corporation also we are going to do today only. But let's first understand, in case of partnership, there will be three scenarios in the same format I've explained in the class also. So please understand, if a taxpayer is contributing any property in the partnership firm, and against that he is receiving interest in the partnership firm, I am talking about interest. Okay, but let's say I'm contributing the property, against that if I'm just receiving a rental income or some minimal amount, or let's say the whole amount of selling the property to the partnership firm, that is not a partnership interest. Okay, but I'm going to receive a share in the profit of the partnership firm against the property which I have contributed. So this contribution will be non-taxable. Got it, guys? Like, I'm audible, can anyone confirm? Like, I'm audible properly, na? Girish, am I audible? I'm not receiving the answer, guys. Okay. Thank you for confirming. Next is taxpayer is contributing a property, against that the partnership firm is paying property, other property, and also he is receiving money. So here the taxability will come. See, anyways, in exam, wherever they are going to ask, they are not going to ask from a particular scenario. You have to create this whole chart in your exam. So what the taxpayer is contributing property, against that is he receiving anything? You will just mention it in the chart format, that whether he is receiving a money plus other property. Note down how much money is receiving. Note down what is the FMV of that other property which is receiving. Now what you are going to do, compare this money with the property which is contributed. Whatever property you have contributed, that might be having certain cost, right? So whatever is the adjusted basis. What is adjusted basis? All the cost which is being incurred to buy the property, plus if you have done any additions, minus if you have taken the depreciation on that. So any addition, deletion, after that when you receive the adjusted basis on the date of transfer, compare that amount with the money. If this money is more than the adjusted basis of property transfer, then you'll have to, the taxpayer will have to recognize a gain. Recognized gain will be how much? Money, whichever you are receiving, the whole amount will be recognized as a gain. There will be 1 or 2 questions into 2 marks question will be there based on this thing. If a partner is contributing, they will give you a case scenario. If a partner is contributing a property in the partnership firm, against that, if a partnership firm is receiving money or any other property. So compare the money amount with the adjusted basis of the property contributed. Please understand the concept. Don't mug up the things. Remember this chart exactly in the exam. When you draw it in your rough paper, you will remember this thing, that this money was going to be compared, has to be compared with the property which you are contributing, the adjusted basis. You have to compare it. If the money which you are receiving, you're receiving more benefit, right? Then it will be considered as a gain for a taxpayer. Got it, guys? Now adjusted basis in the property transfer, whatever is this adjusted basis. And now for taxpayer, you have to also calculate one more thing. Now what is the basis in the partnership firm, how it will be calculated? Adjusted basis of whatever property you are transferring, take it, minus money received, minus FMV. So whatever you are giving minus whatever you are receiving, right? This is the amount which will be called as the basis of a partner in a partnership firm. If it's a positive, take this amount as a basis. If it's a negative, the basis will be 0. Okay. Now adjusted basis for a taxpayer in a new property, this new property which is receiving, right? For this taxpayer, at what amount he will calculate this other property in his book, consider this other property in his book, that will depend on adjusted basis minus cash. Okay, what is the adjusted basis of property which you have already transferred? This minus money received. Compare it with the FMV. Okay, I'm going very slow, guys. I know since this is a revision lecture, but this topic are very important. Even though if you have not understood in your regular class, this is the last chance to understand it. This is the only way where you can remember this topic. Okay, whatever is your, see, whatever is the adjusted basis, means can I say this amount minus cash, whatever money you have received, compare it with your other properties FMV. Whichever is lower will be the basis of this other property. Got it, guys? So this is simple to understand. When a partner is contributing a property, against that if is receiving a money plus other property, first you have to see that step 1, check whether the money is getting money is more than the property contributed or not. If yes, if money is more, then you have to recognize gain. If no, then no need to recognize gain, right? But the basis of a partner in a partnership firm will depend upon this thing, adjusted basis, right, minus money received minus FMV. If you have a positive, take it as it is as your adjusted basis. If it's a negative, the basis will be always 0. Got it, guys? Next is, there is a third scenario which is most important. Just mark it like this. There will be straight away 3 to 4 MCQs based on this. Okay, but it will be twisted like in a different manner. If a taxpayer is contributing property plus mortgage, Along with the property, it might happen that the mortgage is also attached to that property. So now the partnership firm will have to pay the remaining outstanding amount on that property. So what will happen? If the mortgage, compare the mortgage amount, if the mortgage is more than the adjusted basis in property transfer. Okay, if the mortgage amount is more than the adjusted basis in the property transfer, this thing happens, then you'll have to recognize the gain. Means, see, till now I was paying the mortgage, but now the whole property is transferred to the partnership firm. I don't need to pay any mortgage interest or principal anymore. The partnership firm will take care of. So can I say this is a benefit for me, right? So whatever is the mortgage which is getting transferred, if that amount is more than the property value, the adjusted basis of the property, then you will have to recognize a gain. Okay, now what will be the taxpayers share in the partnership firm? What will be the interest percentage? It will depend on whatever adjusted basis of the property you are transferring. You have to reduce this mortgage, multiply by percentage share of other partners in the partnership firm. Means, let's say there are already two partners which were there and they are having 30%, right? Two partners are there, they are having 30% share in the partnership firm. Now the another taxpayer is entering into the business with the 40% share, right? So whatever is the mortgage share, outstanding mortgage, let's say 50,000 mortgage was outstanding, you'll have to take a 50,000 multiply by share of other partners, that is 60%. This will get reduced from the adjusted basis of the property which a person is transferring. Got it, guys? And then the remaining amount which you receive is the basis of a partner in the partnership firm. Please remember this formula. I have already explained the concept why we do this in the class, but right now, since it's just revision, just remember this. The share of other partners, now that will get reduced. See, till now, just I'll simply explain in a quick manner. Till now, I was paying $1,000 as a mortgage payment every month. But now my amount of the liability is also transferred to the partnership firm. Now, in partnership firm, there are 3 partners. Those 2 partners are also going to bear the liability, right? Whenever you are going to pay, the partnership is going to pay the interest, expense or anything, all the partners will be equally liable for that particular liability, right? Up to the basis. Let's say A, B and C is there. These 2 partners are limited, but at least up to the basis they are liable now for this particular liability. So that is why their share will get reduced. The mortgage into their share will get reduced from whatever adjusted basis you have transferred. Got it, guys? So this is what in case of partnership firm we are going to do. Next is, in case of same, just look at the partnership only, guys. Don't look at the corporation and S corp. That we will be doing in when we start with the corporation chapter. For partnership, what will be the adjusted basis in the stock for the taxpayer? For the taxpayer, what is the adjusted basis in the stock of the partnership? If property is transferred, the adjusted basis of stock will be the adjusted basis of property. The first scenario, if we talk about here, 3 scenarios we did. The first scenario, if we're transferring just the property. So here for taxpayer, it is non-taxable, but the basis for the taxpayer will be what? Whatever is the adjusted basis, that you are directly going to take it as a adjusted basis of a stock of a share in the partnership firm. If a property plus mortgage, both things are transferred, then what is the basis? This we have already seen right now. Whatever is the adjusted basis of the property transfer, you are going to reduce the mortgage into share of other partners, right? Other partner share you are going to reduce, that much will be the adjusted basis of a partner who is transferring the property in the partnership firm. Next is money or other properties received. If against your contribution, if you receive money or any other property, the second case this is, right? So adjusted basis of whatever property you have transferred minus money minus FMV, that amount will be the adjusted basis of the interest. See, all these things I have included in the first chart only, but just for your understanding, if the question is asking, the whole chart is designed in that manner only. If the question is asking about just the taxpayer's stock basis, then you have to calculate this. If the question is asking that how much tax the partner is going to pay, right? So there you have to take this calculation. Basically, the tax payment will come, the capital gain will be applicable only in case of second scenario, okay? Then we'll see that the third case is what the corporation or the partnership, if they are receiving the property, they'll have to recognize the property at some amount in their books, right? So what is the adjusted basis of the property which they have received, plus if the partner has recognized the gain in their books, that much amount you have to add. Please remember this formula. People get confused in this formula, so please remember this. Go it in the stepwise. Remember this chart very well. All your 3 chapters will be covered. Your partnership, S corp, C corp, everything will be covered in these 3-4 pages. So please remember this chart. Adjusted basis of property, which a partner is transferring, right? The adjusted basis. In this you are going to add what gain the partner has recognized. In second scenario, if you have seen, if the money received is more than the adjusted basis, right, you are going to recognize the gain. So that much gain which you have recognized, you just simply have to add it to your adjusted basis of property received. Okay, over here. So this amount a partnership firm will recognize in their books as a property cost basis. On that, the depreciation will be charged, and then later on, when it is sold, the same amount will be considered. Adjusted basis will be calculated like this. Okay, got it, guys? Now distribution we'll do later on. First, contribution related, all the scenarios we have completed, right? If you guys have any questions, since this is a live batch and I would like to give opportunity to those who are watching it live, if you have any question in this, please put it in the chat box. I'll answer your question. Okay, so those who have not attended live, for them I won't be able to answer the questions, but still if you have any query, just put it down in the chat box, or if you're looking a YouTube video, just put it down in the comment box. Any queries regarding the contribution, if you have right now, just put it there. Okay, next is, let's come back to our partnership topic again. Just a minute. Yeah. Okay. Now let's come to the guaranteed payment. Now what happens now? Yes, Girish, first chart for the partner and the next is for firm. Right now we have just done the chart for the partnership firm. Corporation is yet to be done. This is just a 1065 related chart we have done. Okay. For corporation, the treatments are different. When the member contribute, the treatment is different. You have to check some criteria. We'll see that at that time. Okay. Right now, just don't get confused between corporation and the partnership and the S corporation. Okay. Just remember about the 1065 partnership firm. Guaranteed payment by a partnership firm to a partner. Now let's say partnership firm is paying certain amount to the partner. There will be 2 things. One will be guaranteed payment and one will be the minimum payment. Okay, so see what will happen. Minimum payment means, just a minute. Minimum payment means anything which is being guaranteed by the partnership firm to a partner. Okay, let's see what it is. Partner performed the service or provided the capital for use. For any of these 2 reasons, the partnership firm might be paying the amount to the partnership firm, right? Sorry, partner. Partner might have provided his or her services to the firm. Let's say I am an enrolled agent. I provided my taxation service to the partnership firm. We are running a whole partnership firm. They are a business consultancy firm and I'm providing my services to them. So I'm performing my services, or let's say I'm just providing a capital as an investment, right? For against that, if I am receiving certain amount, right, that will be a guaranteed payment. Okay, but now guaranteed payment will be first you have to check what is the minimum payment, and then whatever, see, I'll just take one example. We have earned $60,000 from a partnership income. Okay, now there are 2 partners, partner A, partner B. What is the distributive share, or let's say 50-50% they are sharing. So Mr. A is going to receive 30,000, Mr. B is going to receive 30,000. So this is a distributive share. But as per the partnership agreement, or let's say they have mutually agreed that Mr. A is going to receive a minimum of $50,000 each year. Okay, now out of this $50,000, 50,000 is the minimum payment. I can say minimum payment each year. They have pre-decided that the partner is going to receive a 50,000 as per the agreement. So 50,000 is the minimum payment. Now this, how 50,000 is being paid? 30,000 is his distributive share. So can I say whatever is the remaining 20,000 which a partnership firm will have to extra pay, right? This 30,000 is straight away coming from the net earnings, but the 20,000 extra the partnership firm have to pay from the pocket. This extra 20,000 is called as a guaranteed payment. Now you guys are clear what difference between the minimum payment and the guaranteed payment, right? Minimum payment means this much, this total amount we are going to pay from, let's say this is a whole amount which we are going to pay, right, each year to the partner. But out of this, anyways, the partnership firm is earning a 30,000 of profit. So can I say whatever is the extra payment which we are going to do out of the pocket from the partnership firm will be the guaranteed payment. There will be one question based on the guaranteed and minimum payment. Please understand that whatever is fixed charge which is been pre-decided is the minimum payment. Now that minimum payment will be paid by the partnership firm in any form. It can be, first you have to just reduce your distributive share directly from the amount decided. Got it, guys? So let's read it. Guaranteed payment allowed as a business expense. When a partnership firm is paying this extra 20,000, this extra guaranteed payment which they are paying, that much will be allowed as a business expense as a deduction on a 1065 form. Okay, got it? On the first page it will be allowed. Also, when the partner receives his guaranteed payment, it will be included in his income. He will include this 30,000 also, and he will include this 20,000 also. Means total 50,000 of benefit which is receiving, the partner will include in the 1040 form as an income. Guaranteed payment, the partner's distributive share of ordinary income will be included in them. As I mentioned right now, it will be included on 1040 form also, and from 1065 it will be reduced as an expenses. Got it, guys? Guaranteed payment means what? The calculation is simple. Take the minimum payment, if any, minus distributive share. So 50,000 we took in our example, minus his distributive share is 30,000. So 20,000 is the guaranteed payment. If it's a positive, it will be guaranteed. If it's a negative, let's say you have guaranteed only 20,000. We are going to pay you only 20,000. But since the earnings are higher, you receive the whole 30,000. Can I say there is no guaranteed payment now? The whole minimum payment is been paid to the partner. So the partner is going to include whole 30,000 as it is in their return. Okay. Guaranteed payment you are going to reduce from the partnership income, and whatever is remaining, if this is a loss, the partner must report full guaranteed payment as the ordinary income. Okay, partner will separately take into account the distributive share of loss to the extent of adjusted basis. See, one best example I'll give you. Let's say my partnership income is 40,000, but my guaranteed payment is 50,000. Can I say now this is a loss of 10,000? Since this was an income now, right? This is an income. Okay, due to this, my partnership income is showing a loss. My partnership net earning are in losses. So what the partner will do, partner is going to fully recognize this as an ordinary income. Okay, and then just show this 10,000 as a distributive share of loss in that K1 line 1. As a loss, it will be shown as 10,000, but on the same schedule K1, just below that, there will be a guaranteed payment word, guaranteed payment tab, where you are going to show the whole 50,000. Got it? Partnership fiscal year ending on 31st March. So April to March. Now see here, you have to see that if the partners, if a partner's share of interest is different, and if partner's tax year is different and the partnership firm's tax year is different, so in that case, in which year the K1 will be included? There was one question I remember in the exam based on this. In which year that income will be taxable in the 1040 return of a partner? So if a partnership is following a fiscal year which is ending on 31st March, everyone knows what is a fiscal year which is ending other than the December. So if a fiscal year is ending on 31st March, that is 1st April to 31st March, K1 will be issued after 31st March. Right, after 31st March, partner will include the guaranteed payment. In which year they will have to include the guaranteed payment? In the year in which the K1 is received, that is 2022, not 2021. So let's take partner is following tax year beginning from 1st December 22 to 31st December 22. But partnership firm is following a tax year which is 1st April 22 to 31st March 23. So can I say the K1 will be issued after the year end, and year is ending in 2023, right? So the year in which you are receiving the K1, so the partner will include the K1 of this whole fiscal year in the next year, that is 2023. There will be one question, guys, please remember this. The guaranteed payment taxability will depend on the year in which you are receiving the K1. This will happen basically if the tax year is different for the taxpayer and it is different for the partner, right? So the year in which you are receiving the K1, right, in that year you'll have to include it in the income, not in any other return, not in any other tax year, sorry. Partner follows a calendar, it's mentioned over here. Partner follows a calendar year. Partner will include the guaranteed payment in next year, means let's say year in our example it is 2023, right, and not in 2022 tax year, even though his year is ending in 22, but he has not yet received what is the actual amount of income which he need to include, right? That's why it will be included in the year in which K1 is received, right? Next is partner is receiving a health insurance instead of guaranteed payments. Some partnership firm will not give you a guaranteed payment. Instead of that, what the partnership firm is doing, they is just paying the insurance premium for the health of a partner. If this insurance premium is paid by a partnership firm on behalf of a partner for the services, then this premium amount will be treated as a guaranteed payment and it will be reduced at the business expense, means it will be treated same as a guaranteed payment. What was happening in guaranteed payment, from the P&L will take it as a deduction, and for partner it will be included in the gross income. But if it is paid by the partnership plus it is reduced from the distributive share of partner, then partnership cannot deduct the premium. Simple example is what? $100 is getting distributed, right? Let's say they have earned $1,000 and the Mr. A share is just 10%. So his distributive share is what? 100. But since the partnership firm is paying the premium of $10 for this partner, what the partnership firm will do, they'll reduce the premium amount from this and they'll just distribute $90 to the partner. So once if it is reduced from here, you cannot reduce again. If it's reduced from here, right, you cannot reduce it again as an expense from the P&L. In this scenario, what is happening? The $100 totally is paid to the partner, right? So the $10 which is the premium is paid out of pocket by the partnership firm. So whatever is paid out of pocket by the partnership firm, they'll have to include it as an expense, and then on the other hand, the partner will include it in the income. Okay, I hope you remember this example. Those who have done the class in the regular session, we have already concluded this whole scenario concept. Okay, sales or exchange of property. Now what is happening if the partnership firm is selling a property to a partner, or a vice versa case is happening? Okay, and if both are related, then whatever is the loss, it might happen that they are selling at a less than FMV. Because of the relation being a partner in the partnership firm, I will be selling at a lesser price to the partnership firm, right? So whatever loss I might have incurred, that will be disallowed to me. But when the partnership firm is selling it further to the unrelated party, they are going to reduce the gain. Whatever gain they are having, they have to pay the capital gain tax, right? So whatever is the gain, they are going to reduce the disallowed loss, which was not allowed to the partner. Means previously when I transferred them, I was not allowed to take the loss. But when the partnership firm is going to sell it further in the market, they will reduce the disallowed loss from the gain. Okay, and also apply the rule of sales or exchange between. So this is the rule of sales or exchange between the related party. Now if interest in capital or profit is more than 50%, then either directly or indirectly. Okay, directly, indirectly, I think definition is there in the next page, we'll see that. Okay, so in that case, if it's a gain and you're holding more than 50% in capital or in the profit interest, then no capital gain. Okay, so if more than 50%, if you're holding, then it will be called as ordinary income. You're not going to recognize capital gain at that time. It will be ordinary income. But if you don't hold more than 50%, then it will be a capital gain for you guys. Let's say I am holding 40% interest in A&N company, and now when I'm selling certain property, right, to them, I have a gain. I have a gain due to sales of this property to A and company. Since I am holding less than 40%, this gain will be recognized as a capital gain. But if I am holding more than 50%, let's say I am holding 60% into this partnership firm, right? So whatever gain I am going to receive, whatever gain I have realized, that will be ordinary income. Okay, there is a difference between capital and the ordinary income. Capital gain will be chargeable at a different tax rate, 0%, 15%, 20%, right? This will see in the basis of the property chapter how the capital gain tax rate is charged. And in case of ordinary income, it will be directly dealt with my normal marginal tax rates. Okay, if there is a loss, if you are a partner in a partnership firm, then it will be disallowed, as I mentioned, and the partner's basis, my basis will get reduced from that loss. Okay, but in future, when the partnership firm is going to sell it in the market, whatever loss was disallowed, this amount will get again reduced from the amount of gain which the partnership firm is going to incur. Okay, this is a sales or exchange of property. Everyone is clear, I hope. If you are holding more than 50% directly or indirectly, what does that mean? If you are holding directly, you know what is directly. Directly, you are owning a share. But indirectly means a corporation, trust, partnership, estate which is owned by or for its shareholders, partners, beneficiaries. Let's say I'm a partner in a partnership firm A. Along with that, I'm also holding a share in some other partnership firm of more than 50%. So those two partnership firm will be internally related person. And if they transact anything internally, they both will be liable for this rule, that is loss will be disallowed. Okay, individual considered to be owned by the family, brother, sister, half brother, half sister, spouse, ancestor. So all my relatives will be considered as indirectly owning the share. Let's say Mr. A is owning a share in A and company. A's son is also owning the share in A and company. Both are owning a share of more than 50% into it. Or let's say the person is owning 20%, but the son is owning 30%. So can I say collectively they are owning more than 50%. So anyone who transact with A and company will be called as a related party transaction. Okay, I hope this we have you guys might have done in the regular class very well. In the regular notes, you can just recapture, like remember it, this thing again. Okay, now this all three scenarios we have already done in the other chart. This is there in the detailed format over here. When a person is transacting in the form of property, against that if he receives the interest, there will be no recognition of the gain and gain or losses. Now there is two terminology which you have done, inside basis and outside basis. Inside basis means what? Partner's tax basis in the asset. Okay, what is the basis, at what amount he is transferring, that is inside basis. Outside basis means what is the basis of a partner in a partnership firm. When you check the balance sheet, here is a partner's equity account, capital account. So this is a outside basis for a company. Okay, anyways, for a partnership firm, they are going to repay it back to the partner. So that is the outside basis. And whatever is the partner's basis in the asset, that is their inside basis. Okay. Next is if you're transferring a property, against that if you receive another property, will be treated as a sales of property if the distribution is only for the contribution, plus the partner's right to distribute does not depends on success of operation. Means I can say that I am contributing the property to the partnership firm. Against that, if I am receiving another property, this will be the situation of a like kind exchange if I don't have any interest in that partnership firm. Okay, got it, guys? Next is basis of property contributed by partner. Basis will be simple. You have to check whether there is a mortgage or not. If there is a mortgage, you have to reduce the mortgage percentage into outstanding mortgage. The percentage will be the share of other partners. Okay, you'll have to reduce it from the basis of the partnership interest. If it's a positive, then guys, are you see my screen properly now? If it's a positive, then you'll have to consider it directly as a basis. If it's a negative, the excess will be recorded as a gain. Okay, so here are the few examples. Let's do it very quickly. Adjusted basis of property which a person is transferring is 8,000. On that, the mortgage is attached. So can I say when I draw this chart, the 8,000 is the adjusted basis plus 4,000 is the thing which is mortgage which is attached to this basis. Okay, so can I say this mortgage which is attached to this basis is less, right? It is less. So in that case, what will be my basis? Take the whole 8,000 minus 4,000 into, let's say the other partner's share is 80%, my share is 20%. So I'll reduce 4,000 into 80% from this 8,000, this will be my new basis. Okay, now let's say instead of this 3,200, 9,600 is getting reduced. Instead of this 4,000 mortgage, the mortgage is on the higher side, and due to that my basis calculation is negative, so I'll recognize a gain of whole 1,600 and my basis in the partnership form will be 0. Got it, guys? Understood everyone regarding the basis thing? I hope you are getting this point very well. This whole chapter is very important. I'll just say that if you are not understanding, just repeat the video again and again, since it's a recorded video. So please go through the recordings again and again to remember the formulas, the concept. Okay, don't mug up anything, don't mug up the formulas, just understand the concept. If I'm contributing something, mortgage is attached, other people are also liable for that mortgage, right? Think practically. So just reduce that much share. Whatever I'm contributing mortgage, only my share will be considered as a basis of a partner in a partnership firm. Okay, so if a person is contributing a property in the partnership firm, and within 1 year of my contribution, the property is distributed to other partner, okay, other than the partner with more than 50%. So the first person will recognize the net pre-contribution gain. Guys, understand this thing. Pre-contribution, actually this is built-in gain. We'll also see the built-in gain or losses, but first understand this concept. Me, if as a partner is contributing some property in the partnership firm, right? So at that time, just property I'm contributing, I have not recognized any gain, right? Remember the first case. Now the partnership firm is selling that property within 1 year to some other partner or any other person who is not owning more than 50%. So can I say at the start when I transfer, I should have recognized the gain because this is a sales of the property, but since I'm receiving the partnership interest, I have not recognized it. So now when this thing happened, within 1 year this thing happened, I'll have to recognize a pre-contribution gain. Okay, I hope this you have done in the class. We have also understood that very well in the class, the concept and everything. Now, right now, just understand that, remember, recapture that example. Gain will be recognized by the person who is transferring it at the first place. What will it be? FMV of the property at what price on this date? What is the FMV of the property? Minus adjusted basis of his interest. I'm talking about interest. Okay, adjusted. So at this point, what is his adjusted basis of partnership interest? See, right now you might have confused. Adjusted basis of property is different, adjusted basis of interest is different. Okay, so what is his interest in the partnership firm on the date of this sales? Okay, so you have to take that adjusted basis. You have to receive any money received in case of distribution. So when you receive, when this transaction is getting happen, let's say you receive certain money also, so reduce that money from the adjusted basis. Okay, and then you have to compare it with the FMV, reduce it from the FMV. That much gain you have to recognize. This is a pre-built gain. Pre-contribution means before contribution, like there was a gain. Now when you contributed the property, there is a gain. FMV of the property is say $100,000. You might have purchased so many years ago at just 50,000. So 50,000 was the gain that you didn't recognize at that time. But now within 1 year of your transaction, the partnership firm is selling it to some other party. The partnership firm is having the gain. The whole gain will not be recorded as a gain for the partnership firm, but a certain gain will be recognized by the partner who has contributed at the first place. How much will be recognized? FMV of the property. You'll have to reduce the adjusted basis of interest in the partnership minus money received. That much amount you have to reduce from the FMV of the property which is getting transacted. This gain will have to be recognized by the person, which is known as pre-contribution gain. Okay, I hope everyone understood this thing. Now in case of built-in gain or losses, this is the same thing which we did over here, but just a little bit changes will be there. Let's understand that. The partnership must allocate among all partners any income, deduction, gain or losses on the property in a manner that it will account for difference. Okay, means whenever a partner is contributing certain property in the partnership, and when partnership is selling the property, this is not about within 1 year or within 2 years, 3 years. This is any time when you sell the property, whatever gain or loss which you are receiving, it has to be allocated amongst the partner. right? But here in this case, in built-in gain or loss, what will happen? What is the difference between FMV and the adjusted basis? That is your gain, or it can be your loss. Allocate to the contributing partner only up to certain percentage. What is that percentage? We'll see that. And remaining will be allocated to other. So let's say Mr. A contributed a property to the partnership firm at that time. The basis of that property is adjusted basis plus recognized gain. If you remember the chart, when a partner is contributing a property, right, what will be the basis for the partnership firm? We have just done it a few minutes ago, that if a partnership firm is receiving that property, take the adjusted basis and add if the partner might have recognized gain. When the partner might have recognized gain, they might have received the money, right, against the property or any other property, and that money amount is higher than the adjusted basis of contribution. If this thing is happening, they will have recognized the gain. So that much gain they might have recognized, and the adjusted basis will be the new basis of the property. Okay, so the person who have transferred the property, you have to remember, for that person, particular amount will be allocated. What will be that? Take the FMV of this property minus this adjusted basis, only and only I'm not talking about the recognized gain, only the adjusted basis. You have to reduce this much. This difference amount will be totally allocated to only and only Mr. A, and remaining, if any, will be allocated to remaining partners in their ratio, in the sharing ratio. Got it, guys? I hope built-in gain is clear. And if there is a loss, same way the allocation will be done. First, it will be allocated to the person who is distributing this property, and how much allocation will be done, whatever is the FMV minus adjusted basis, that much allocation first will be done to that partner, and the remaining will be allocated to other partners. Got it? Same way in case of 1 year distribution, within 1 year there is a pre-contribution gain. Whenever you contribute, you have to recognize this as a gain. Please remember this two topic. There can be one hidden question somewhere there in the paper, and some people get confused that this question is from which topic. It is actually from the built-in gain or loss, or a pre-contribution gain. Okay, so please revise it again. Next is there is one example, but before that we'll do this contribution of services. Okay, let's say if you have contributed services into the partnership firm. Now this, against these services, you might receive a capital interest, or you might receive a profit interest. I'll just explain a difference in a very short manner. Capital interest means what? When a partnership firm is going to get liquidated, right? Whatever assets are getting sold, you have an interest in the value of the asset also. So that is a capital interest. Profit interest means each year when a profit is earned by the partnership firm, you are going to receive a share in the profit sharing. That is a profit interest. If this thing happens, if you receive a share, that is not taxable. Currently you don't know how much you are going to receive now, so you are not going to tax it. When you contribute your services, against that, if you receive a percentage of share, it means every year you are going to receive a earnings. Anyways, in future year when you receive it, you include it in your Schedule K, right? But in case of capital interest, you have to check, you have to see that it gives a holder, whoever is the holder who is going to receive this capital interest, it gives them the opportunity, a share of proceeds of partnership when it sold the asset at FMV. When they sold the asset in the future, they will get a share of that particular sales. So partner will include FMV in its gross income. This will be the basis of interest as well. Basis of capital interest will be nothing but the FMV of all the asset. Okay, if it's a profit interest, it will not be taxable, but if any of the following applies, it will be taxable. What are the exceptions? Profit interest is related to substantial or a predictable stream of income. Okay, means let's say they can easily know, they are easily aware about this much is the predictable stream, or this much is the profit share which you are going to receive. A fixed number, a fixed dollar are being designated, then that needs to be taxable. Within 2 years of the receipt, the partner dispose of the interest. Let's say I've received a partnership interest, profit interest, and within 2 years I'm disposing of my interest. Okay, next is profit interest is limited to partnership interest in a publicly traded partnership. Profit interest, if it is a limited partnership interest, it's kind of limited partnership in a PTP, publicly traded partnership. Okay, so see, these are the 3 exceptions where the profit interest will get taxable. And in case of capital contribution, you just have to remember that all the FMV of the asset will be considered as a taxable. Okay, so yeah, there was one example over here. Rita and Sophia are both equal partners. right? 10,000 cash is being contributed. Okay, now depreciable property they have in the business, which is having a FMV of 10,000. It is having adjusted basis of 4,000, means after reducing all the depreciation till now, the basis right now is 4,000. Depreciation rate is 10%. Now Arita is having a undivided half interest in the property. In property they have only half interest. So for 10,000 of the cash contribution, how much is the interest of both the people, both the partners? It is 5,000. Okay, so depreciation is 10%. So this 5,000 multiplied by 10%, $500 is my depreciation, which will be allocated to only one person. The adjusted basis is 4,000 into 10%, means this property is having adjusted basis of 4,000. On that, what is my depreciation? It is $400. Okay, got it, guys? So now what will happen? Maximum depreciation that entirely can be allocated to Arita is just $400. Arita is having how much share in this cash? 5,000 and 5,000. What is the depreciation percentage? It is 10%, right? 500, and here when you apply this remaining 10% over here, it is 500. But now what here, one thing is missing actually. The whole property was contributed by Arita. Okay, so the whole depreciation percentage, this will be allocated to her only up to 5,000 her cash basis into 10% depreciation. So whole $400 will be allocated to her only. Okay, the other person, Sophia, she is not contributing the property, so depreciation will not be allocated to that other person. Got it, guys? Contribution of service we have done. Next is example. There will be few back-to-back examples we'll see, and then there is a cash distribution. Okay. So here is basis in the partnership interest is 55,000. Liquidation of her entire interest. Let's say the person is liquidating her entire interest in the partnership firm. So here, whatever is the liquidation, you have to allocate that basis amongst different categories. Let's say apartment house is there in the partnership firm, which is having adjusted basis of 5,000, FMV of 40,000. Office building is there in the partnership firm, adjusted basis of 10,000, FMV is 10,000. Right? So what is the total adjusted basis of the assets which is there in the partnership firm? It is 15,000. What is the total FMV of this two asset? It is 30,000. Okay, so first of all, what will be the basis for a partner? That will be the FMV, which you get the total of all the FMV is 50,000. Now she is having a basis of how much? 55,000. But she's having the basis in the interest, partnership interest is 55,000. But the FMV of asset which is there in existence in the organization is just 50,000. So can I say, so remaining 5,000 will have to bifurcate it among these two remaining these two assets. So what will you do? The remaining 5,000 will be allocated amongst these two assets in the ratio of the FMV, that is 4:1. So 4,000 and 1,000 will be allocating between the apartment house and between the office building. Okay, so adjusted basis in the apartment house, first take whatever was the FMV, that was 40,000, add this much amount, right, 44,000. Same way take the FMV of the office building and add the 1,000, that will come to 11,000 as a adjusted basis in the office building. Got it, guys? Next is cash distribution. Cash distribution does not affect the taxable income unless it is a liquidating distribution. So now we are starting with the distributions topic. If there is a distribution, you have to check whether that is a liquidating distribution or whether that is a non-liquidating distribution. Okay, so first of all, let's see this example. Let's say David and Robert both are equal partners. They have contributed 10,000 cash into the business. Okay, they have contributed a depreciable property which is having adjusted basis of 4,000 and the depreciation is 10%. So what is a partnership basis for depreciation? It will be 4,000 adjusted basis of the property which they have contributed. They have contributed cash also, they have contributed property also. So whatever is the basis of the property will be the basis for the partnership firm. Take the whole 4,000 as a basis for a partnership firm to calculate the depreciation. Now annually what they are going to deduct is they are going to deduct the annual depreciation of $400. Now this $400 will be allocated only to the person who has contributed cash. So let's say only David has contributed the cash of $10,000. So this $400 depreciation part will be allocated only to David, and Robert will not get a benefit to reduce the depreciation. And on the schedule K1 of the David, the $400 will wholly be allocated, not to the Robert. Okay, in practical life you'll rarely see this, but in theoretical concept you have to remember those who is allocating the cash, first the depreciation percentage multiplied by the basis, whatever is the depreciation will be allocated to the cash contributing partner rather than only the property contributed. Even though the property is contributed by only Robert, or let's say both are contributing the property, the whole depreciation will be allocated to the person who is contributing cash. Okay, next is basis in the partnership. There are certain examples, means these are the few scenarios I found unique in which on this basis the questions can be asked. So these are, I can say, IMP questions which you can remember. Let's say three partners are there, all the three are having a profit sharing ratio of 4:3:3. So year end adjusted basis you have to check. Let's say their basis is just 10,000, 8,000 and 12,000. Now they incur a loss of 30,000. So can I say this 30,000 can be allocated between 4:3:3 ratio? It will be 12, 9 and 9. This Mr. A cannot take the whole 12,000 loss because his basis is just 10,000. So you can just take a 10,000 as an adjustment. Same way for Mr. B, only 8,000 is the basis. He can take a loss only up to 8,000. Mr. C can take whole 9,000 as a loss because he is having enough adjusted basis of 12,000. So what is the allowed loss? The calculation will be adjusted basis or the loss allocation, whichever is lower. So allowed loss will be limited to your adjusted basis. This is called as basis rule, guys. We have seen the basis rule, right? This is allowed only up to your basis. This is your basis rule. Okay, next question, these questions are not linked internally anywhere. These are some separate questions, means different concepts. See, in part 2 now you don't have to mug up the theory. Even if you look at one example, you should know what is the concept. So that is why I have put the examples after the topic of the contribution. Before going to the distribution topic, I have just put this example. So whatever is covered in the contributions till now will be explained in an example format instead of just reading the theory. Okay, so R contributed cash of 30,000. He also contributed an equipment of having adjusted basis with 12,000. R is going to have a profit share of 40%, partnership share of 40%. Now, in the particular year, the partnership firm is earning $70,000. In that year, he took a distribution of 20,000. So, can I say what is his adjusted basis? 70,000 the partnership firm has earned. So, his share is what? 40%, right? Minus, he took straight away deduction of 20,000. Right? Got it? Along with this, he contributed two things. What was that? Cash. So, straight away, his basis will be 30,000 plus 12,000. Plus, you need to add the current year activities, that is current year share of profit minus his distribution. So, his basis after this contribution distribution will be $50,000. So, this is what, there is one zero extra in this. So, this is what this type of questions can come in exam. So, two concepts are mixed together. When you are contributing a property, how much will be his basis? That is 30,000. Second thing is contributing a property. Cash take as it is. In property, take the adjusted basis. Here, they'll twist the question by adding the FMV also. Do not take FMV at the time of contribution. Always take the adjusted basis of the property which you are contributing. Right? And when there is a share of profit, you have to check what is a share, multiply that much percentage with the profit, with the share in the partnership firm. So, income of a partnership firm multiplied by 40%, just take that much, reduce the amount of distribution, right? This will be added to his already contributed amounts. So, this is the second important question that could come in the exam. Next most important is, there can be rarely chance of this type of question, but this is a huge calculation sum. Just understand it properly. Mr. A contributed a particular property, or let's say cash, they have contributed is 70,000. B contributed a cash of 50,000. Okay. Now partnership has also borrowed a bank loan. See, 1750 they are having on hand to run the business. Along with that, they were lagging for 10,000 more, so they took a bank loan for $10,000. And both the shares are going to share the profit equally, 50-50%. Right? So what will happen? Mr. A is at risk for how much amount? The amount which he contributed, 70,000, and his share in the borrowed amount, that is 5,000. So his at risk value 75,000. This can be one MCQs. Mr. A is at risk for how much amount? Whatever has the contribution plus his share of borrowed amount he is going to take. Okay. Second is the partner B has contributed 50,000 plus his share is 5,000. But wait, the second calculation you have to do is, you have to compare the 50-50 or the ratio of the contribution 7:5. Okay, so distribute this 10,000 two times, like distribute it in the two columns, 7:5 or equally, and then take whichever is lower. Okay, so Mr. A and B has contributed 70,000, 50,000. The equal ratio will come to 5,000, right? But if they contribute this 10, if they allocate this 10,000 in the ratio of 7:5 in the ratio of the capital contribution, right? Then in that case, what will happen is 5,833 for Mr. A, and for Mr. B it will be 4,176. So whichever is lower, you are going to allocate to them as a at risk value. Not exactly 5,000, not exactly 50-50, or not exactly 7:5. Okay. All right. So this is this third example. So this three example, just remember this all three examples, that can be one typical question based on any of this in your paper. Okay. Now basis, as I made you understand, inside basis, outside basis. Outside basis is something which is called as partners adjusted basis. Adjusted basis plus share of partnership debt. Okay. In case of outside basis, means whatever is the partners basis, that is the outside basis for the partnership firm. Anyways, at the time of liquidation, they will have to repay that amount to the partners. So that is why it is called as the outside basis. Okay. So outside basis, in that case, what you are going to see is adjusted basis of property contributed plus any cash which is contributed plus partners liability assumed. The calculation we have already seen through that chart at the end of corporation chapter. Okay, so that is our outside basis. Now you are going to increase your outside basis with any additional contribution, any distributive share of income. Means if the partnership firm is earning $100,000, then his share is 50%. So you are going to add your basis by 50,000. If you are contributing 10,000, you will add it, right? If you are taking a distributive share of excess deduction for depletion over basis of property, this is nothing but when we are going to sell a property in the partnership firm, when you sell the property, at that time there is a 1250 gain, there is a 1231 gain, right? 1231 is ordinary gain, 1250 is a capital ordinary gain, which you need to calculate when you compare the SLM versus the other basis of depreciation. That much amount you are going to recapture. So whatever is the partner's share in that, right, that gain, you are going to add it back. Decrease means what? You are going to take a distribution, so decreases. If you have a loss, reduce it. If you have non-deductible partnership expenses which cannot be capitalized, which will not be capitalized, and those are non-deductible to partnership firm, that you are going to reduce it. And partnership deduction for depletion, this is increase in depletion, this is reduce in depletion, means that the same thing only, but increases there, then you are going to add it, decreases there, you are going to reduce it. Okay, this is what the outside basis calculation. The typical calculation will not come. Just remember our concept. Whatever you are contributing, just add it. Whatever you are taking as a distribution from the firm, you are going to reduce it. Whatever profit you are earning, just add it. Whatever losses you are going to incur, just reduce it. Two extra thing you have to remember: whatever are the non-deductible expenses, right, that will not be reduced in your profit and loss page 1, will straight away go to the schedule K in the form of partners decrease in basis. Remember this thing, non-deductible partnership expense will get reduced from the outside basis. Okay, got it, guys? So effect in the partnership liability, how and when you are going to include in the liability, what all things will be done. So include liabilities in the basis if it creates or increase the partnership basis in any of its asset, or gives rise to the current deduction, or is a non-deductible non-capital expense of the partnership. Simply remember this thing: whenever there is a liability, now guys, whenever there is a liability which you are incurring for a partnership firm, that will be increasing your basis in the partnership firm. Got it? Let's say I'm a partner in the partnership firm, I'm taking a loan and then investing it in the partnership firm. So, or I am responsible for the loan which is taken by the partnership firm. So that is my increase in the basis, increase in the liability, which creates or increase the partnership basis in any asset. Let's say we have taken a loan and bought an asset. So it increasing the asset's value, right? But that loan which is being taken, I am at risk for that amount that will be added to the basis of my partnership basis. Okay. If a property transfer occurs, the partner is transferring any property to the partnership, treat as having assumed the liability is FMV of the property. See, this don't have to do it from here. We have already done this thing in the proper chart when the property is getting transferred, how it is treated. So next is, if liability increase, that is a contribution of money added to the basis. If a liability decrease, that is this is a formula which you can remember. If you don't understand, still if you're not able to understand the concept, just remember, if the liability increase in the partnership firm, whatever contribution you have made is in the firm, for the firm it is a liability, right? They are anyways going to pay at any time to the partner, so you are going to increase your own basis, those who are contributing it. If liability is decreasing, right, it will be distribution and reduction of the basis will be done. Okay, considered a partner or the related person to assume the partnership liability only to the extent of the personally, where they are personally liable, where the creditors know that the liability was assumed, but the creditors can demand and no other partner will have the economic risk of loss. I'll take one example. Let's say I am a partner in A and partnership firm, okay, A and firm, okay, and I have taken a risk of the liability which was borrowed by the firm for 10,000. Okay, now in what situation I will be called as assumed this liability? If I am personally liable, then it will be called as a recourse liability for me. There is a difference between the recourse and the non-recourse. So for this 10,000, I am personally liable. I will be this $10,000 will be called as a recourse liability for me. Creditors know that the liability was assumed. Now creditors know that for this whole 10,000, I am only responsible. I have taken the loan in my name, so I will be the responsible person. Creditors know that. Third thing, creditors can demand the payment, not from the firm, but from me. And fourth thing, no other partners have economic risk of loss. No other partner is going to incur or bear any loss if I am not able to repay this back. So this whole thing is called as a recourse liability, and I will add this much amount to my basis value. Got it, guys? Okay, now related person definition is given. I'm not going to read it. You can just go through the definition. I'll just read one definition for the corporation when it will be called as a related. If a partnership, if the same person is holding more than 80% of outstanding stock. I am a partner in a partnership firm. Also, I'm holding more than 80% stock in a corporation. More than 80% outstanding stock, or if it's a S corp, more than 80% outstanding stock in the S corporation if I'm holding, then that corporation and then partnership will be called as a related person. Got it, guys? And other all you can just go through it. These are the simple definitions of the related person. Recourse liability, as I explained, if a partner or a related person is having an economic risk of loss. My example, you can just recapture it. If I am holding in a partnership interest in a and firm, and if I have borrowed $10,000 to buy an equipment and invest into the firm, so the $10,000 which I am at risk, right, it will be my recourse liability. So any partner related person by agreement or by law makes a net payment to the creditors, whoever is going to make the net payment to the creditors, or contribute to the partnership. General partner are usually jointly and severally liable for the partnership debt. Okay, next is non-recourse, means no partner or related partner has an economic risk of life. Other than me, those other partners are not going to have any risk to repay that 10,000. I am only liable for the $10,000. So that is called as non-recourse. Got it, guys? Now next important part is unrealized receivable and inventory. What do you mean by unrealized receivable and inventory? This is simple thing which you have to understand, that at the time of distribution, first let me make you explain the meaning of unrealized receivable and inventory. It is simple, that if you are going to contribute, if you have asset. If you look at the balance sheet, there is a asset side over there. There are some fixed asset, there are some current asset. In current asset, whatever are your inventory, those are unrealized, and whatever are your receivables, right, account receivable, those are, and this thing happens in case of accrual. Taxpayer will have a receivable, means they have recorded their sales in books as and when the goods are sold, not on the date when the cash is realized. For them, there won't be any unrealized receivable or inventory. But if I'm a cash basis, I'm not going to record the sale unless and until I sell the goods and I receive the money, right? So the day when I'm going to receive the money, on that day I'm going to record it as my, I'm going to record it as my income in my books. So if you are a cash basis, then in that case you will face this problem, that is unrealized receivable inventory. I know the wording are a little bit complex, you might get confused. Just understand the logic. If I'm a cash basis taxpayer, when I'm going to sell certain amount in the market, unless and until I realize the amount in cash, I'm not going to record it, right? If I'm a cash basis. So for me, I have sold the amount, I have not received the cash. For me, whatever amount I have sold, that will be what? Unrealized receivable. But now think from the point of view of the accrual basis taxpayer. If I'm an accrual basis taxpayer, I'm recording my books, maintaining my books on accrual basis. As and when I sell the goods, I'll record it as a sales to receivable, right? But if I'm cash basis, I will not record it unless and until I realize the cash. So for cash basis taxpayer, it will be unrealized receivable or unrealized inventory. Okay, so basis will be all cost plus expenses which are incurred in case of unrealized receivable and realized inventory. Partner using cash method will have this type of asset, unrealized receivable and inventory. Okay, and will not see, this is the same meaning which I explained. I'm not going to read it again. If it's a partner, if it's a partner who is using accrual method, they will be not having any unrealized receivable. Okay, because they will be recording as and when it is received. Includes goods delivered and payment is treated as received. Service rendered or to be rendered, or any other item of gain considered as a ordinary income. Okay, next is it will also include, the inventory will include property included in the partnership inventory if on hand or held primarily for the sales to customer. This is the meaning of inventory which is given over here. If the inventory is sold or exchanged by the partnership, which is not a capital asset, or if it is a 1231 property, which is not a 1231 property, it is talking about, see, wherever in the book I have explained it like this in the short form, it means it does not include this thing. Okay, sold or exchanged by the partner, which is not a capital asset, those kind of things will be your inventory. Okay, and the third one is if the property is held by the partner selling the partnership interest or receiving the distribution. Substantially appreciated. Okay, no, you don't have to remember this. Next is partnership distribution to the partners. If now there is a distribution, that can be divided into two parts. One is if there is a current distribution, means on the day-to-day business, if a person is taking normal distribution from the earnings, so that is your normal distribution, that is your current distribution. If there is a current distribution, directly just reduce that much amount from your basis amount. Okay, but if it's a liquidating distribution, or let's say it's your partnership interest is getting terminated, then you will have to recognize either gain or a loss, either capital gain or a capital loss. In case of current distribution, you can just reduce it from the basis. So partnership is distributing money or a property to the continuing partner is called as current distribution. If liquidating distribution is there, then completely terminating the partner's interest is the liquidating distribution. Okay, so partner must report his distributive share in the return in the year in which the distribution is occurring. The taxpayer tax years ends in, let's say, 2022 tax year, right? So the year in which it is getting distributed, in that way you have to recognize either as a gain or loss from the value of the basis. Okay, if there are hot assets is nothing but your unrealized receivable and unrealized inventory. Okay, then there will be a complex calculation which we'll see right after this topic. Okay, we'll see over there. But remember this thing. Okay, let's first see that only. Let's say if it's a current distribution, Okay, and in the distribution there are unrealized receivables and unrealized inventory. Then in that case, what will happen? Unrealized receivable inventory will come in what situation, in which type of taxpayer? Can you mention in the chat box, guys? Unrealized receivable and unrealized inventory will come in which type of taxpayer? Yes, correct, in only cash basis. Okay, so in that case what will happen? Let's see first directly the example. As I mentioned, I'll explain you in the example format so that it is easy to remember. Okay, this is liquidating. Just a minute, guys. Let's take this example. Okay, let's say the basis E is having a basis of 55,000 in the partnership firm. Okay, now what the partnership firm is doing? Partnership firm is distributing property, which is A property and B property. Okay, understand it very well now, guys. It's very easy to understand. If you remember in one shot, then it's great, well enough, or else you will again and again get confused. Basis of whatever property you are receiving, you have to compare it with the FMV of that particular property. If you have received appreciated property, means can I say this A property which you are receiving is having adjusted basis of 5,000. Now the FMV of that property in the market is 40,000. What is the unappreciated amount? Means can I say the value is 35,000 more in the market. Same way for B property, the basis is also same and the FMV is also same, 10,000. So there is no appreciated basis over here. How much distribution E is getting? 55,000. First of all, allocate this amount to the basis of property which you are receiving. I am receiving a property of, let's say, 5,000. This basis is 5,000, 10,000. So out of this 55,000, first I am going to allocate the 5,000, 10,000 to A and B which I am receiving. Second step, follow the stepwise only. Do not allocate in any other sequence. This is the sequence which you need to follow. Second sequence is there any appreciation? Yes, A is getting appreciated by 35,000. So I am going to allocate the next 35,000 from the 55,000 to A, property A. Okay. Now whatever is remaining out of 55, reduce 5, reduce 10, reduces 35. Whatever is remaining 5,000, I will allocate it in the ratio of the FMV, that is 4:1. So for A and B, the value will be this 5,000 plus 35,000 plus 4,000. Same way for B, the value will be 10,000, 0 and 1,000. That will be 11,000. Okay, so this is how when a partner E is receiving the property and still it has been not been liquidated, or whatever property they are receiving in their books, in their tax return, at what amount they will recognize it at 44,000 and 11,000. This allocation is depending first on adjusted basis, second on unappreciated amount, and third whatever is remaining will be divided in the ratio of FMV. Okay, got it, guys? So let's come back to our topic over here. Yes. Okay, if it's a distribution, if it's a current distribution, then if there are unrealized receivable, unrealized inventory, you have to first allocate it to the unrealized receivable, unrealized inventory, right? And then whatever is the remaining, if it's negative, then record it as a gain, or if it's a positive, then you will just reduce, consider it as your adjusted basis, the new basis. So let's say partner's adjusted basis is given, reduce any money, or money is simply an amount which you will directly reduce it if you are receiving money, or if you have received any other property, just take the adjusted basis of that property. This amount, if it's negative, take considered positive, it's considered as adjusted basis. If it's negative, the excess will be recognized as a capital gain for the partner. If it's a liquidating distribution, you have to straight away recognize a capital gain or a capital loss. Money distributed in the form of cash or any discharge of liability plus any marketable securities if received. Money, if it is distributed, will be cash or any other discharge of liability or any marketable security if it is received. Okay. All right, next is partner's basis for the distributed property. If you have received a property, so what will be the partner? For partner, first you have to calculate that whatever property you are receiving, now whether the basis, the adjusted basis of that property is less than or more than the basis of your interest. Okay, let's say I am having a basis in the partnership firm of 1 lakh. When I receive a property, the adjusted basis of that property was 1,20,000. So I am receiving a higher amount, right? So what you are going to do is check the basis, partnership basis, right, and compare it with the adjusted basis of interest. Okay, minus, let's say just a minute, guys. Basis of, let's take this example. I'm receiving a property with a basis of 1,20,000. Okay. Second thing, I am receiving I am having my partnership interest of $1 lakh. So what is the basis of property which I am receiving? That is 1,20,000. Now I will compare it with my partnership interest, that is $1 lakh. But let's say along with this, I have also taken a distribution in the form of cash of 20,000. So I'll reduce straight away this 20,000. Now my new adjusted basis is 80,000. I'll compare this 1,20,000 with this 80,000. So can I say this is an excess distribution which I am getting extra amount of 1,20,000 as compared to 80,000? I am receiving this amount, right? Got it, guys? So this much amount, if it's a positive, then my maximum basis of profit, see, 1 lakh minus 20,000, so 80,000 is positive, right? So this is positive, then this is my maximum basis of property. I'll not recognize the property at 1,20,000. I'll recognize it at 80,000 only. If this is negative, let's say I've taken a distribution in an excess amount, I've received a cash amount also, I've taken a distribution of 1,20,000, 1,40,000. So this is if negative, then the partner will recognize the capital gain, and adjusted basis of interest will be 0 and basis of property will also be 0. Holding period will start from the holding period of the partnership firm when they have purchased the property. Okay, got it, guys? Any question till now? If you have any question on this, please put it in the chat box, or you can put it in the comment section, those who are looking the recorded session. See, I'm not going to put this recorded session on YouTube. I'm going to give a particular access to those person who are having exams, or you can just request the access from me, because I can see in live session also. See, already these videos are recorded and kept on the YouTube. Okay, the live sessions I was doing only for the people who are actually going to appear in the exam. Now they think that since they are going to get the recorded session, there will be a misconception at this point. Now I'm not going to provide any recorded session to the person who have not attended. If they want the recorded, they can request it to me, right? Let's move further. Next is, so even if you guys are going to attend in the upcoming session, please attend it. For any reason, you'll have to give the reason to get the recorded session, else you are not going to get any recorded sessions from now. Okay, the way I'm going to do, I'm going to put my inputs. You should also put your time at least to attend the live session, else there is no need to make the session live. Let's see adjusted basis to the partnership immediately before the distribution. Okay, so this question, there will be one question on this. New basis will be adjusted basis minus money, or the basis of property, whichever is less. Okay, so you have to check that this calculation you need to do, check the properties basis with whatever is the basis of your partner in the partnership firm, reduce money distribution. If it's positive, take as it is the basis of property. They will ask you that if a partner is getting a property from the partnership firm, what is the basis of that property? What will be his basis in the partnership firm now if he's getting the excess distribution? So that's why you'll have to do all this calculation, do all this formula. Okay, this is the same example, you can just go through it. This is the same example of this, but we have taken the example of 1,20,000, 1 lakh, and this 20,000 and 80,000. So here just the numbers are getting changed, else everything is same. Same way, there is one more formula, one more example, just go through it, right? Next is liquidating distribution. Losses can be recognized only if distribution meets all the following. If it's a liquidating distribution, what will happen? You'll have to recognize the loss if it's a liquidating distribution. Okay, so loss can be recognized only if the distribution meets all the following conditions, that is adjusted basis of partnership interest is more than distribution, partner's entire interest is getting liquidated, and distribution consists of only money, unrealized receivable, unrealized inventory. If these three things happen, see, all is mentioned over here. Then only if you have a loss. What do you mean by loss? Let's say my partnership interest, my basis of in the partnership firm is still $1 lakh, and now the whole partnership firm is getting liquidated and I am going to receive only $20,000, and this $20,000 which I am receiving is in the form of cash or unrealized receivable or unrealized inventory. Okay, I am receiving this 20,000 against these three things. Then what will happen is, whatever is 80,000 loss for me, right? I've invested $1 lakh, but I have existing base of 1 lakh, but against that I'm only receiving $20,000. So that is a kind of loss for me. I'm going to get only $20,000. So whatever is 80,000, I can recognize it as a loss due to liquidation of a partnership firm. Now, adjusted basis of the partnership interest, if it is more than the distribution, right? My adjusted basis is what? 1 lakh. It is more the distribution of 20,000. Second is partner's entire interest is liquidated. We are liquidating our whole entire interest. We are not going to continue anymore in the partnership firm, right? That is a liquidation of entire interest. Third is distribution consists of only money, unrealized receivable, unrealized inventory. Got it? Amount of loss to be recognized. Outside basis just before the distribution. What is the amount of loss? Outside basis just before the distribution will be considered minus amount received or unrealized receivable or unrealized inventory received. Okay. All these three things you can reduce from your outside basis. Just out. What is the outside basis? I have already explained that. Right? Outside basis is nothing but the partner's adjusted basis. So what is partner's adjusted basis in our example? 1 lakh we are going to reduce by the 20,000. So whatever is the 80,000 which is loss will be recognized as a loss. Okay. Now in case of liquidating, taking the same example, my whole interest is getting liquidated. I'm just not going to get anything, but I received, let's say, unrealized receivable, inventory, cash, property, whatever I'm going to receive, I am going to allocate. Let's take same example. This $1 lakh will be allocated amongst whatever I am receiving based on that. First of all, straight away allocate everything to exactly the unrealized receivable amount, unrealized inventory amount, cash amount which you are receiving, or if you're receiving a property, allocate it to the adjusted basis. In case of non-liquidating, what was the situation? These two cases were not there, right? Unrealized receivable inventory, we just directly allocated it to cash, allocated to the adjusted basis of the property, right? Second step, we were allocating it to the unappreciated amount, and then whatever is the remaining, that 5,000, right? Out of 55,000, the 5,000 remaining will be adjusted amongst the adjusted basis in the partnership for all the property. FMV we were allocating, just remember like that. Okay, same way, but only one difference is there. Just only one difference is there. Unrealized receivable, unrealized inventory will be there in the case of liquidating distribution. So first you have to allocate the amount for them, and then remaining will be unappreciated amount, and then remaining will be FMV basis. Okay, so this was the one example which we took, but along with this, along with the adjusted basis, if we have a cash value also, I think there is one example based on that. Let me check. Yeah, here it is. See, if the adjusted basis is 1,50,000, now you have to allocate this 1,50,000 first amongst unrealized receivable, unrealized inventory. Right, here you can see inventory is 70,000. Straight away take the 70,000. Cash, straight away take the 30,000. For cash and inventory, there won't be any difference in FMV and adjusted basis. It will be the same. So take the, either you can take 70,000 plus 30,000. First allocate the whole 1 lakh to your unrealized related things. Okay, cash, UR and UI. Okay, unrealized receivable, unrealized inventory. Then you have to adjust, allocate it against the adjusted basis of property. Okay, so here what property you are receiving? Building and computer. So what is the adjusted basis? 80,000 and 20,000. Okay, but first you need to check that there is a appreciation. I know you have already seen that 10,000 appreciation will be, but what if it comes a depreciation? So in that case, the remaining 50,000 first allocate to the depreciated one. Okay, so reduce this 10,000, and then remaining 40,000 will be allocated on the basis of the FMV. Okay, so here you can see is 10,000 will be allocated regular basis of the computer by depletion amount. Bifurcation will be this 10,000 will be bifurcated amongst the ratio of 80,000 and 10,000. Okay, 80,000 and 10,000, this is the way, this is have to remember in the exam also. Please draw this chart and remember whatever amount you are depreciating, now in this you have to take the new depreciated amount. And in case of appreciation, you have to take only the adjusted basis of this. So 8:1 it will be allocated, and whatever is the remaining again will be allocated in the same ratio, 8:1. So for building, I will be recording it as 88, 89 and 35, 556. I'll total it up and consider it as a basis of a building for me in case of liquidating, and also for computer I'll add up these two amounts and it will be the basis of the property, and this two amount will be straight away called as my cash and the receivables, unrealized receivable. Okay, got it guys? So this is all about distribution of interest in the partnership form. Here a certain, like all the examples which we have done, I have just included it in a summarized form. You can just read this chart and revise all the concepts which we have done till now. In case of current distribution, let's revise it. Adjusted basis of the partnership interest minus cash received, if any, right? It's a current distribution, adjusted basis of partnership interest. Do you remember that 1 lakh, right? 1 lakh was the adjusted basis. Sorry, not 1 lakh, this one. Just a minute, what was the example? Yeah, this one. Yeah, 1 lakh, and against that you receive the cash of 20,000. So 80,000 or the basis of the property, you are going to compare it. Okay, 80,000 is positive, right? If it's a positive, then just use as it is as a basis. If it's a negative, just add here one value, that is 0 will be the basis if it's a negative. Okay, if property received, if you are receiving a property which is more, which is having the basis, in our example 1,20,000 we received, right? It was having more value than the basis of 80,000, then what will happen? Excess will not be taxable, but the partner will have the adjusted basis in the property, which is known as the property will have adjusted basis of 80,000, not more than that. Okay, you have to remember that example. If you have book, if you are like studying right now from the book, please mark down these examples in the book so you can remember and revise it again and again. Okay, third one is adjusted basis of the property received plus money received is more than the partner's basis of interest. Then what will happen? Partner's basis cash and property's basis will be the property's adjusted basis. Got it? Simply you have to remember adjusted basis of property received plus money received. Whatever you are receiving, property is also receiving and money also you are receiving, it both the total, if it's more than the partner's basis in the interest, right, then the partner's basis will be cash amount plus whatever is the property's adjusted basis. And for property, you are going to recognize the adjusted basis is the adjusted basis for the partner. Got it? In case of distribution I'm talking about. Now in case of liquidating distribution, simply you have to treat it as a capital gain if you are receiving more amount as compared to your basis. If you are receiving lesser amount, you have to recognize a loss. But how you are going to allocate it? Allocate the adjusted basis of property in the partnership plus unappreciated amount plus excess amount in the ratio of FMV. So this much amount you are going to receive. Let's say you have a basis of 1,50,000, but you are receiving $2 lakh. So first allocate this $2 lakh in the cash or unrealized receivable, unrealized inventory. Then unappreciated amount. Okay. Then whatever is the remaining, allocate in the ratio. But can I say there is a 50,000 of capital gain for you when your basis is 1,50,000, but when you receive a distribution, it is in the form of $2 lakh. So 50,000 excess distribution which you are receiving, that 50,000 is your capital gain if you are doing a liquidating distribution. If you are doing a current distribution, it will be directly reduced from your basis, and if it gets negative, the basis will be 0. Got it guys?